All right, so let's continue the trade. You know, like we're in the trade, and so we were at 15.20 was one profit target, and then another 32 cents is what we said, but like basically three of these grids. They're 10-cent grids, I guess. The next one will be 15.50. This is I think where we got cut off. So that would be right here at the top of this candle, and we're only like 7 minutes into the trade. I gotta move my video camera. Okay. And then the price pulls back down. Okay. And then it starts going back up again. And you would not be stopped out because at this point, this is profit target number 3. You would have set your your stop loss to profit target number 1, which was down at 114.6. So see how much breathing room that is? That's really good. And that's based on that little trigger candle. You know, it's based on the math from the little trigger candle. And it works out really well. So the next point from there is 115. The last one was 15.2, then 115.8. Okay, so you would take off on this candle here. But here's something interesting, and this is why sometimes you need to take notes during these things because there's so many little rules. And if you just have a pencil and you start writing down these rules, you'll actually have a winning strategy. So, you know, maybe you ought to. And this is another rule. Here we go. If there's a red candle during the run, that's signifying kind of a pullback. Okay, and if after that pullback there's 2 green candles in a row, then you set your stop loss now to the bottom of that red candle pullback. Okay, so 2 candles in a row there did happen after a red candle. Here it did not. Here it did. So therefore now we set our stop loss all the way over here, 115.33. These rules, it depends how much you know about stocks and stock trading and charting and price action and stuff. But if you know quite a bit, you can see how these rules actually are really smart. Because what's happening is when pullbacks, you had a big run there. You see all the green? You had a big run, but now pullbacks are starting to occur. So it's almost like the run is at the beginning of, you know, it's petering out some. It's losing the full momentum. It's not full momentum anymore. It pulled back a little bit. So that's why then when it has 2 candles in a row at least, and you put your stop loss below right there, it makes a lot of sense because things could turn around now and then you'd be out like at the right point to where you would maximize your profit. That's basically a rule to continue to maximize your profit. So you raise your stop loss, like we said in the first method, every 2 profit targets to the profit targets that are 2 below, remember, so you keep stepping that up. But additionally now, we're adding every time a red candle pulls back and then is followed by 2 green candles to raise your stop to the bottom of that red candle that was just before the 2 green candles. Okay, so we continue on, another minute goes by, we have this moment here where we have a red candle, and if we have a green candle followed by another green candle, we would have raised our stop right there. Oh, and by the way, we're taking profit, so we were at 15.2, 115.5, so 115.8, we take off more, and we're talking about between 10% and 30%. Now, this is, I think, our 4th profit target. So if you had taken off 30%, 33%, like thirds, you'd already be out at this point, fully out. Or what you could do is you could take off a third and a third, and then for your last third, maybe you could take off, you know, like 10%, 10%, 10%, which would be 33% of what you have left. But you know what I mean? So you could do something like that. You could have a method where you could kind of like, you know, ease your way out or start with very little and ease your way to bigger portions that you take out. My math shows that taking 10% out at each point and then just continuing to raise your stop loss gives you the most, because when you stop out, you still have so many shares left. You actually have, like, you know, maybe 50% of your position left, and you got to bring that all the way up. So mathematically, you get more that way. So I don't know, personally, oh, somebody else is coming in. Hold on, I got to admit them. I personally use 10% when I get out. All right, so now, then when you have two red bars where the second red bar breaks the first red bar, the bottom of that second red bar becomes the new stop loss area. And it essentially means that if there's a third red bar, you're totally out. Like you should get all out. But look what happened here is the price went back up a little bit, and you don't know. I mean, maybe it could have gone up another green candle, and now you'd still be in, and you'd have this nice stop loss right there underneath that candle. So that's another good rule. So if there's two red candles in a row where this next red candle is like significantly below that first red candle, then you set the stop loss point now to below that second red candle. If it was just like two red candles just like this, like almost right next to each other, and another one's like a penny, that kind of didn't really count yet, you know? Has to be like doom, doom. Has to be like a move down. We're going down, down, you know? Not like doom, doom, and then doom, and they're both happen to be red. That's not significant as far as that rule goes. So that did happen though here, and then the price went back up, and then went back down, and boom. So you would have gotten all out right here. So you would have captured that move right there. That's pretty good. And the reason why you were able to get in was because of all those qualifying rules at the very beginning, remember? So you're looking for a little candle near the 20 period moving average. It doesn't have to be intersecting it like it shows there. It doesn't have to be. You're hoping it'll be red. In this case, I talked you through why, because this one's green, it's not that big of a deal because it was almost red. So, but if it was like kind of like strong green, you know, no. But if it was a red candle, or if it's like just a doji, or just like this, is slightly green, because that little body is just so thin, then it qualifies. And it broke that price. The next bar we entered, and we took profits, and we got out right there. So that was pretty awesome. We have somebody on an iPhone coming in. Now check this out. Then the price dropped back to the 20 period moving average, which is, it doesn't have to go all the way back to it. It could be somewhere in here floating with space in between, like look at this one. It could be like that, okay? And it put in a red candle with like a little red body. That's perfect. That's perfect. So we're about to enter the next trade. We got out here, and we had 2 minutes of break. I mean, you had just enough time to go take a piss and come back. And like, you know, sometimes it can be like that. And then look, that becomes a qualifying trigger candle. So now you're like hoping and praying that this stock just doesn't start tanking red, because now you have no entry and you want to make money. So you're kind of hoping and praying the next candle is going to be green and break the high of the trigger candle. It could start red. It could go down and then come back up. But once it goes higher than the open of its candle, it turns green. So, but it'll be green by the time almost 99% of the time it'll be green by the time it breaks the high of this price, unless there's a gap, okay? And that could happen if you picked an illiquid stock, like even Oracle kind of trades illiquid and has a lot of gaps. But you need a very liquid stock. So then you enter there. So you enter there, and the stop immediately is below that red candle right there. So if the price ever goes down below that, you get out instantly, all shares or all contracts, whatnot. And then the price goes up, and where do we take our first profit? So yellow line is 13 EMA. No, this yellow line, sorry, that's the 20. SMA, no, don't use the exponential moving average with this system. Simple moving average. Because the exponential moving average gets the line way too close to the stock all the time. You can get stopped out a lot and you can get too much trigger information, too many signals. Okay, so now we're in, and then the first profit target we got to start thinking about, on top of the stop loss, is double the length of that trigger candle. So this trigger candle in this case, the top of it is about 115.53, and the bottom is 115.32. So that's 21 cents, and you double that. So 42 cents. It will be your take profit points. Okay, 42 cents. But you don't have to do all that math. You can just kind of eyeball it and go, okay, it's about 20 cents. Or what I do is I use the grid. So here I can see it's approximately 2 grid spaces for the length of that candle. So every 4 grid spaces, I'll be taking a profit. Last time it was 32 cents, remember? Now it's 42 cents. We were using 3 grid spaces. Now it's 4 grid spaces because it's every grid is 10 cents. All right, so above your entry. So okay, so 1, 2, 3, 4. So the first profit's right here, 115.96, and then 1, 2, 3, and it doesn't continue to make a good price anymore. And then you get 2 significant red candles in a row. So you stop out if the next one breaks the bottom of that second candle. That's like an all out point. And it did. And so you get all out right there. Okay. You don't know, I mean, it's easy to see ahead right now and say, oh, but wait a minute, we should have just stayed in because look at it go. No. You have to have these rules because you don't know it's going to do that. It could be crashing at that point. Okay. But the reason you get out is to secure profits. Okay. And if it goes up again, it's commission free. I mean, almost everywhere you trade now is commission free. So you just get back in if the trigger shows that you should, which is what I'm going to show you now that it does. And we'll follow that again. But first of all, we get out here, we got in here, we get out here. That was another profitable trade. And it was like fully managed because we almost got another little profit out of that, and we were going to raise our stop loss to break even, remember? So, but this time we got out at the second rule that I was talking about, the 2 red candles. All right, so there's 2 profitable trades already, and this 20 period moving average line is still upward sloping, so then we're still qualified for calls and long entries. And then again, you see it kind of pull back towards the 20 period moving average line. That's the yellow one. And put in a red candle. The red candle, it's not small, but it's, in my opinion, it's just about small enough that you probably would have gone for it. It's a, I can't think of the word, but like, you know, it's like almost yes or no decision. And then the price breaks that price, so you would have entered there and stop loss here. Right, the bottom of the trigger candle, and you enter here, and then the price starts going up, and then it oscillates, which is okay, we're still in the trade, and then it goes up, 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 up. So where take profits would have been double the length of the trigger candle. Trigger candle size is about 2 grid spaces, so first profit is 4 grid spaces. I think we were saying 20 cents, you know, so 40 cents. So this candle is about 20 cents, so 40 cents above. 116.03 would be 116.43, so that first profit is right there. And so you take 10% off to 20% off. It's not a huge chunk. And looking forward, you know, you probably wish you took it all off, but you can't know that. So you just follow the system. You just follow the system because you don't know what's coming. And then still the break even, I'm sorry, the stop loss is set at the bottom of, which one was it? This candle. Okay. And the price pulls back and you get those 2 red candles and it's back at the 20 period moving average. But the second red candle is not really strong, right? But the thing is, they all moved down. Even this green one, you could almost think of it as red because look, it was inside the other candle essentially, and the next candle went lower. I mean, we're basically getting a downtrend, and if you were to combine all 4 of those candles, it'd be the equivalent of 2 stronger red candles. So, you know, you want to get out right here is what we're saying there. So you get out there, you got in here. So you made like 5 cents, and with slippage you might have made 3 cents or lost 2 cents. but that's still good because compared to all the money you made over here, we didn't really calculate it up, did we? 115 point, where did we get out over here? 115.61 from 114.3, so that's a $1.60. And if you had like $25,000 account, you get about 100 shares. A dollar. What did I say? A dollar. What was the difference? Anybody? $1.30. I don't even remember. $114.38 to okay, $1.30. So you made $130 compared to $100 times 2 cents would be losing $2 on this other trade up here. So you can see how it's like you lose very little, but you can win large amounts using this rule. And you get about 5 to 1 to 10 to 1 win-loss ratio on this. So it's very good. And then we continue on with the trade. The next entry, we got out, this one went up here. We took some profit and then stopped out right about around here. And now the slope is starting to turn flat. So that's something to pay attention to. See, it's not really going up. So, and the price of this green candle did not go above the high of the trigger, potential trigger candle that we're looking at here. Because I know you're thinking, okay, there's a trigger candle, we're going to go in again. But no, the entry didn't happen. We would only enter if a real strong green candle came and like overtook like that red candle and maybe the next one even. Be beautiful if it even overtook this one, but like you'd want it to knock out like all 3 of these candles. The next one, so it's like a real good, strong, bullish breakout. Otherwise, don't get in. You're going to get chopped out again. So let's see what happens. The next candle, it is a little strong. And it did make the curve start going up, and you don't want to miss an entry. So I'm going to say we went in there. So we got in again, but now what happens? And then the stop loss on that would be below this red candle here. Not this big long green one that didn't overtake the candle. It'd be right there underneath that red one. All right, and the price doesn't really go in your direction. And we got, not only do we get 2 candles that were, good, strong down candles, so therefore we should get out if the price breaks that low, but it actually hit the low of your stop loss, which was the low of this candle here. So there's one losing trade. And you would have lost 116.26 minus 116.08. You guys need to type in the math there. You guys are, some of you, I know you can do that math real fast. 0.26 minus 116.08, 18 cents, so you lose $18. All right, these are the prices to pay to be potentially in it for some of them that go really, really good. And Apple didn't do like great today. It had that one run and then it just started like going sideways all day, So to already be where you're at, where we lost like $2 on the other trade, and then when did we just lose there? I forget. And I think we lost $16 on one other trade. I'm not sure. And whatever we just lost on that one, or maybe that was all the trades. But then $140 or whatever it was on that first trade. So we're still in great shape, still up like $120. By the end of the day, I don't want to trade this whole thing. This is going to take forever. By the end of the day, you will have entered between 3 and 7 tasty trades, and you will have made between 1 and 3% on the value of your account. So if you have a $25,000 account, you'll have made $250 to $750 in one day doing this method. All right, but I do want to show here that look what happens now. The moving average line starts to go down. So that means it qualifies for bearish trades, okay? But you only want to get in them when it's getting close to the 20, closer touching the 20 period moving average from the other side, upside down, right? And all the colors are reversed now. Everything's reversed. So you're looking for a little green candle, which this one kind of is, that gets blasted out by a red candle. So this, could be the case here. But my worry here is looking at this, that's about how far off the 20 moving period, the 20 period moving average that these ones were. In other words, this far off of the 20 period moving average is the end of the strength of that move. You see, like recently, like when things start curving like that and they go in the other direction, it starts to get choppy. And so you're not going to get a big, gorgeous downtrend like this was an uptrend over here necessarily from an entry that's around here off of the 20 period moving average. This one was just below it. It was really tight with the moving average, and then it opens up. You see, they call that an alligator move, alligator mouth. But here, the point of entry is kind of so far off of the 20 period moving average that you kind of wouldn't go in, because you can see, relatively speaking, on the other ones, that was about the distance of the ends of moves. That was the distance of the ends of moves recently as things have turned into choppiness, right? Okay, hopefully you can kind of judge that. That'll help you stay out of that move right there. But we're still looking for anything tasty. Now here comes a green candle, like a lot of green moves, but there's nothing that actually fully like triggers it. And this moving average is pointing downward, so you would not take long moves there. So that kept you out of that trade. So far, if you've been using all this judgment and all these rules and all, you're paying attention in this day trading, you just day trade one stock the whole day. That's what you can do. So far, you haven't gotten into a move here, and you haven't gotten into a move here. Everything turned flat and is a little bit downward sloping here. So now we have this little green candle. This one could qualify because it's near the moving average, and we were in a downtrend. But there's two things that are working against us. One, it's kind of flat. It's not actually super trending. That 20 period moving average is going to tell you if it's in a trend, and it's not. It's not in a strong trend. And then the second thing working against us is the next candle was not a red candle that broke the bottom of that green candle, which would have signified going short or buying puts and going down. So again, we did not get in. The curve starts to move up, and since this is like a real big, strong candle, it depends on where the momentum came from, towards the end of the minute or at the beginning of the minute. If it was the beginning of the minute and it was like really strong, I might have entered there, because on a lot of strength, it can start turning the curve up, and then all of a sudden it's the beginning of the trend for getting in. But it's like less qualifying because it's so flat. So you could not enter there. But if you did enter there, then you would use the methods for stopping out, and you probably would have stopped out around the stop loss. So that's another trade that didn't work for you, or maybe you didn't get in because you might have wanted to wait for the slope of the moving average to be stronger. You can do that. You can just wait for more sure moments. They'll come. Here, you can already see there's another one coming. So then the slope is going up. Okay, if we don't know what's coming, then we're like basically going like this. Now the slope is going down, and we would want to see a green candle near the small green candle near the 20 period moving average, and then a red candle break it down. Okay, so we got kind of a small one. What I would hope for now is a big, strong red candle down, and it didn't really come. It needs to be next to it or within the second candle, and it breaks like it has a lot of strength, and it just didn't come. So we didn't get in, but the slope is sloping down. So we still don't have a qualifying green candle that would be small. This one could qualify, and it's sloping down. So now if we got a strong red candle that would break that bottom of that green, we would enter. And I'd have to be there in that moment to see when the momentum is, but that one really kind of wasn't probably it. If it's kind of like just, you know, you wouldn't have gone wrong if you had entered there. Like, let's say we did enter there, you know, things did move in your direction. You don't know which way the market's going to go. So when you're in a choppy region, you keep getting into these and getting out for small losses. And that's just the way it is on a choppy market. Some days you're going to have a lot of choppiness. Other days you're going to have these big long runs, and you're going to make 1% on choppy days instead of 3%. But on the other days you're going to make 3%. So it works out in the end. And in this case where I was talking about strong candle, where was it? I think we went in over here. You would have put the stop at the top of that green candle because everything's in reverse. And go ahead and ask questions, guys, in the chat there. If you have any other questions, like maybe this is boring for you, just ask what you would like to ask about today. I'll gravitate towards your question. I'll see it. So you're still in the trade because you didn't get stopped out, and then this green one here does stop you out. So this one would have stopped you out right there. So you're not in the trade anymore. And it's downward sloping, and this one, oh, hey, there's Sean. Sorry. Hey, Sean, welcome. Downward sloping. So, you know, relatively speaking though, like the size of these candles, this one is not small. It's small, yes, but it's not small compared to the most recent candles. Like the current price action, that candle's not small, it's the same. And you want it to be relatively small. So I'm not sure that I would get in here. Again, the line is not sloping down very strong, and the candle was not super qualifying because it's kind of average sized in comparison to recent price action candles. And then the momentum on this candle might not have been strong in the moment. I have to know it in the moment. So that was probably not an entered trade. And again, if you want to just wait till these slopes on these lines are more obvious, that can be a fine qualifier. But as you can see, coming ahead here, we're going to want to get in. So in any event, we don't know that's coming. And where were we? We're getting close. So the line here is flat. It's not curving up. Now it's curving up a little, see? And you can almost get the feeling like, man, this could be the start of something. Because you can see just, 5 candles in a row. Last time that happened was here, but it could be another choppy moment, so we'll see. The line is really curving now, and curving more. And then it had the red candle, and you're like, oh, good. Well, I'm glad I didn't get in. I'll need to watch this multiple times for it to soak in. I hope you post this for replay. Thanks for your man. Yeah, I will post that, Dave. But I also did it on Thursday, and I gave the full strategy in a little more detail. I'm kind of running through it right now because you can really see the strategy on Thursday. And then Monday's class, we went over exits, no matter what trade you're in, whether you're in a swing trade or a momentum trade or penny stock, a supernova trade, all kinds of just methods for exits and money management. All right, then the next candle is a little bit green. Now, notice that the slope is still going up, okay? That's indicating that the trend is staying, it's continuing. And what we're hoping for is a little red candle that's close to the 20-period moving average line. And we're probably not going to get it because we looked at the chart before and it's just tons of green candles. So we did miss this move. Now you don't want, let's say the next candle after this little red candle, which is not really little, relatively speaking, but let's say it was little. If the next candle to that was green and it broke out the top of that candle, you would not really want to enter because you're so far off of the 20-period moving average line now. You want it to be closer. because the 20 period moving average line kind of signifies how off the mean, the average price, the current action is. So if it's far away like that, it has a higher probability of pulling back. You can almost think of it as like it's elasticity or gravity or something. Okay. Yeah, again, we're too far off of that yellow line, the 20 period, to really enter even on the second candle that broke this red top right here. It just wouldn't be as wise because we're so off of the 20 period moving average. And even when we go back, when we had that strong trend, well, that one, got far off. But by here, that much space is not real reassuring. So it means you'd be getting in at potentially the end of a move instead of the beginning of a move. And that's okay. You don't have to get in. It's not like an ingenious, perfect system. You don't have to get in every single opportunity. It's okay. Because maybe during this time you're watching a second stock and you end up getting in another stock. And that other one had a better setup. It's all about the setups being excellent. And this right here, even though you missed this move, it just didn't give you the excellent entry, and that's okay because the opportunities will come. You're going to miss lots of opportunities, and that's okay. You're going to still make money. That's the important part. Now over here, I would have hoped that this was like a red candle because now we're getting close to that 20 period, but it wasn't. So we did not enter. Now over here, we're getting some little red candles and it's getting close to the 20 period. That's interesting to me. I don't know what happens next. I don't really remember things. I have to write them down, or I just use looking at the information, the historic information, like charts. So I really don't remember which way Apple went today, but let's see what happens. I think if I remember, it did not continue to rally. But I would be looking for a green candle to break that high of this little red candle now. This is like a good setup. It's a good setup moment. I do remember at some point during the day, the entire market crashed. It was crazy. All right, so there. I would have gotten in right there at the top of that red candle on this next candle. Okay? Because it's the beginning of the alligator mouth opening up. That's what they call that, the alligator, I forget what it's called, alligator jaws, I think. So anyway, the mouth is closed, they say, and then it's going to open up, and you get to grab a huge trend. But it doesn't always happen. Price gets choppy, as you can see in the previous area there. It's you don't get it, but when it does, it really can go. So let's see what happens. So we're in the trade. We got in at 116.65, and the size of our profits are going to be double the trigger candle, the profit points. The trigger candle was 116.64 to 116.58. So this is a very small trade. So we're talking about 6 cents. Did I do the math right, guys? I'm really good at math, I promise, but I'm tired. All right, 6 cents. So 12 cents is our take profit points. Okay, so we're looking from 116.64 to take profits at 116.76. Okay. Just let me know if I ever do the math wrong. Next candle. All right. We did get to take profits. 76 is right there, just about near the top of the candle. So we took some profits. Profit 0.1. All right. It went more. 76 plus 12 is 88. So we're talking about 116.88 is where we're hoping it will go to, so we can take some more profits. And at that point, remember, profit 0.2, you move your stop loss to break even. And the stop loss, just to be really clear again, is at the bottom of that little red candle in the beginning. In the beginning of the trade, it's right there. So 116.58. But now at 116.88, if that happens, I don't know what the next candle is. If that happens, we take that profit and we move our stop loss to break even. So let's take a look. Not yet. Little hope. There we go. So 116.88. And technically, it actually hit 87. So actually, we haven't hit that point yet. It depends, though. If you're just using like eyeball judgment, maybe you might have taken out right there. I don't know. You know, everyone can trade slightly differently, and using eyeball judgment in this system is perfectly fine. But some of you, maybe you have a fast setup and a good trading system, and you could even type in the order. Like, I'm already going to set this. You could maybe have them all set, 10%, you know, outs at all those levels. You just be typing them all in. You'd be working hard all day, but with all those points. But maybe that's for some people that works really well. Maybe that's what they want to do. So anyway, next candle. Even though it's red, it did hit our target, and so we got our second profit target, and now either we've taken off 66% of our trade at the maximum of thirds, or we've taken off 20% of our money, and we've raised the stop to break even. All right. No. Did anyone catch it? Okay, let's see if anyone can catch it. Where's the stop loss right now? If anyone's been following along and you remember one of those rules, that's a hint, the stop loss actually went up higher. Okay, I'll tell you, because I don't see anybody typing, but okay, I'm going to give it a few more seconds in case somebody's typing. At bottom of point, PT. Oh, price target. At bottom of PT. What do you mean by PT? No. Anyway, okay, here it is. I'll just tell you. So, no, it's not that. It's at the bottom of this red bar. Why? Because I said if there's any red bar pullbacks, that if it's followed by 2 green bars, then you move your stop to the bottom of the red bar. That's one of the exception rules that helps you continue to raise your stop loss. I mean, you need all these rules because you're trying to maximize profits, and that's one of them. So now the stop loss is actually right there. It's not at break even, which when you take your second profit target, which we just did, you would normally move your stop loss from the bottom of the trigger candle to the break even. But instead, we had another rule kick in where it was a red bar or set of 2 red bar, whatever, you know, we had a red bar region followed by 2 green bars. So then you set the stop loss to the bottom of the red bar. So now the stop loss is 116.75, and you took out on your second profit target at 116.88. All right, let's keep watching the price action. 116.75 is the stop loss, and this second candle goes towards kind of our rule that we were talking about when you have 2 red candles, and relatively speaking, the 2 of them are strong, you know, relatively speaking, they're, you know, significant. I kind of would say that this one isn't, okay, but this one was enough that you could combine them and use your rule to start to kick in. It doesn't really matter because only like 2 cents away is 116.75, the stop loss on the bottom of this one too. So you can almost combine all those rules to say like, oh my goodness, if the price goes, you know, right around here, like right around here, if it doesn't go up from here, this is like exit time. And let's see what the next candle is. It's green and it didn't go lower. So I think you would still be in the trade, okay? I would be, because it didn't, I would be watching real carefully and making sure it didn't go another penny or 2 lower, and it didn't, and we didn't get stopped out. But let's see, the next bar, maybe we get stopped out. No. There, now we're stopped out. And that was at a profit. We got, you know, stopped out doesn't always mean at a loss. So you got stopped out at a profit. You moved your mental stop loss up at varying different rule points so that the trade turned profitable for you. So that was another little profitable trade, and it would have been 100 shares and a $25,000 account. And we took, we got about, let's see, we entered here at 116.64, and we got out at 75. So we were like 15 bucks, or what is that, $10 or 20. But we did get an extra price target hit up there, so we maybe made $20. That's good, you know. You're making money. That's good. You need every little thing. Sometimes you lose $20. You need to make $20 in order to balance that out. So that's quite all right. It doesn't have to be these mega wins all the time. What it has to do is get you in and keep you profitable. That's all. Then the price goes down, 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 and the moving average is not really downward yet, so you wouldn't really qualify for a negative trade, a short, selling short, or puts, not yet. But right here, you can kind of see it starting to curve down. I think that's because of the next candle's already drawn. In real time, it might be straight right there. So you're not really qualifying for in any strong way for any direction right now. And so let's keep watching, and it starts to curve down. It starts to flatten because the price started to go up a little bit there, so it started to flatten. And even though this looks like happiness, like good bullish action, you would not enter because this slope's going down. So it's in a downtrend. This is not the start of an uptrend necessarily. I could be wrong. But it is most probably a pullback in a downtrend. So it's pulling back to the 20 period moving average. Now, if a green little bar were to show up close to this 20 period moving average next, I would like that because then the slope will slightly go down a little more, and then if the next bar is red and shooting straight down through it, that's an entry on the bearish side. Let's see what happens. Okay, that's kind of good. It's not, relatively speaking, very small, so it's a little bit not fully qualifying, but it would depend on the next. I'm sorry, it needed to be green. So on the bearish side, this would have had to have been green. We're not looking for red candles on the bearish side, little small trigger candles that are red. We're looking for green. Okay, on a downslope, you're looking for a green, and it didn't happen, so we didn't get in. Here, this one did though. This would have been an entry. I like that. We're approximately close to the 20 period moving average, not, way off in extended. Not right there, but like, see what I'm saying, right here. Because if this curves down, we're relatively pretty close. It's okay. So we would enter here on the negative. Now you would hit sell on your, sell 100 shares short if you had $25,000 account. Or if you had like just do the scale it down, 100 shares for $25,000 account. Let's say you had a $2,500 account, you'd get 10 shares. Okay, if you had a $250 account, right, you get 1 share. You really couldn't do too good. But if it's commission free, you could probably still do quite all right. You grow your account, and it'd be good practice. But of course, it takes money to make money. So, it'd be nice if you had like 500, 1,000, 1,500, 2,000, or you were real good with the options. All right, so now we're in short here, and then the stop loss is above the trigger candle because we're doing everything upside down now. We're going short. So the stop loss is here, 116.6. The trigger point was 116.54. That's 6 cents size of a candle. So our profit targets are going to be 12 cents apart. So this is another small trade. We know that ahead of time, but it's okay. It's good practice to get in these moments. You don't even know. I mean, who knows? Like, maybe this is the point in which the market started crashing and we're going to make a lot of money. I don't know. Let's see. Next one. Yeah, actually, that's a delicious move right there if we're going negative. So 116.54 plus, what did I say, 12 cents, minus 12 cents would be 116.42. That's our profit target. And we did hit it right there. So we took out 10% or to 30%, 1/10 to 1/3. And then the next bar was lower, and from 42, 12 cents would have been 30. So we actually hit that too. So we take out another 10% to 33% right there. And next bar was a red candle, but somehow it kind of went higher. That could be how it works sometimes. You're still in it though. Oh, and when we took that second profit right there at 116.3 on this bar, we moved our stop loss to break even. So whatever price you got in at, we move it now to break even. So now you can't lose money, and you're safe. but it's a mental stop loss, so you just have to be ready to sell all shares like right at the right point. Don't mess that up. Get good at, use some good software. Make sure it doesn't have much delay, if at all, and that your orders fire fast. Okay, next candle. We're still in this. It was 116.30, so 116.18 would be our next target. And it looks like it wants to pull back to the 20 period. And when that happens with the two green bars there, that's like having those two red bars on the long side, remember. But these two were not strongly going against the trend, so they did not kind of qualify for setting the stop loss now to the other side of the green bar. But we'll see. Let's see what happens here. Actually, so it kept us in the trade, and we hit that other profit target point, 116.18. And when that happens, we move, because this is, I think, what is it, our third profit target we've hit. So now we move the stop loss to the first profit target, which was 64.52. I don't recall at this moment. 54.42. It was right here, 4.2. So now, even if it goes back and gets stopped out at your first profit target point, it's positive. It's not just break even, it's positive. So that's cool. Next, it goes down there. Okay, that was a decent pullback right there. And so now, thinking in reverse, you would put the stop at right there at the bottom of that candle. That's just too strong. So now if the price continues to go past there, you had two of those in a row. See, they're not next to each other, but they're, kind of in a row. There were two strong negative directions. Green in this case is negative. It's not good because you're making money going down in this case. So you have two negative candles, they're green, and you put the stop loss now, stop loss for everything, all shares left at 116.33. Let's see what happens next. Okay, and you got stopped out. So somewhere in there, you sell all shares. But that's fully profitable. That was actually more than the stop loss of the profit target one that you set, which was 116.42. So instead, you got out at 116.33 with a little slippage. That's another 10 cents from 4.2. So I think overall that one made you like $35 on 100 shares. So that's money. You never know when these are going to turn like massively profitable, and they do. Anyway, I think we don't need to do that all day, do we? All night, do we? Do you get the system? Please ask a question. So what are you unclear about? Anything unclear? So look at that, see? That was a massive trade. It looked like you would have been in it all the way until the two red candles of strength way up there, or possibly over here, but probably got re-triggered entry right there. But would it have entered? And you would want to uptrend. You probably would have entered right there. You even maybe could have entered right like there-ish. Once you get used to this system a little bit, you would know that you could get in as far back as there. But you could also just get in there, and it probably would, because of the rules, it would probably hold you in all the way until right there, and then it would get you back in right there, and then it would hold you in all the way to right there. So you actually captured a good 80% of that move, because then it looks like it goes really haywire. Letting somebody in. Let me get a drink. Do you guys have any questions about options? Does anybody, okay, I'm still confused about your two red candle rule on whether or not to get out. And he says, sorry, I'm slow. No, you're not. Let's see. It's just that it's late and I'm tired, and I'm probably not really communicating it sharply, and I could be better, I'm sure, at it. The one Thursday night class was just like on point, really, really well explained. So that's going to also reinforce everything I'm telling you. So the two red candle rule regarding when it's going up, right? Oh, yeah, where I just mentioned it twice here. I'm saying if the price is going up, and in this case we have a red candle followed by two green candles, so that raises your stop loss to the bottom of the red candle. That's one rule. Okay, and that happened twice. There's another raising of the stop loss. But I'm saying like here, this pullback with these two candles those were big moves. I mean, when those are happening and you're in the trade, you're not going to enjoy those two. They look small in the grand scheme of this because you can see it after the fact. But those two candles are fairly strong. And so because of that, by the time that candle is ending, you will get out if price goes any further. That's the rule. Get out if it goes any further, and it does. It goes down more. See, one time earlier when we were showing one of these trades, the next candle was green and it didn't go down further. It stayed right there, and so you stayed in the trade and it kept going. In this case, you would get out right there, which is great because from entry to there, that's not bad. That's a pretty good chunk. And then you have a little red candle here, followed by the green candle breakout. These two back-to-back green candles break out that high, so you'd re-enter there. So you got out there, and you'd re-enter there. And plus, it's a little bit closer to the 20-period moving average. You kind of have to like remember like all these rules. Remember, and the slope is going up, and all these different things are getting you into really good moments and getting you out when things are going bad. See, if I had said, if we didn't have this two red candle rule, you would still be waiting for it to come back down to either this rule, which was also an additional rule, or it would have been your first profit target or break even, so that wouldn't have been pleasant, So these other rules help you maximize your profits and get out before things turn too sour. You just really don't. When prices start to pull back into the 20-period moving average, you don't want that. You want to be in it for it to be pulling out. Like if you've ever seen like supernovas, just, I mean, there'll be the alligator mouth is just opening and opening, But then when it goes, and you get like teeth clawing back in, it's kind of like those are teeth, That's not good. You can go ahead and get out. Plus, you'll be ready in a few moments if it starts pulling way back to the 20-period moving average. You'll be at a really good point because when the mouth closes is the best time to get in. It's kind of a funny name they give that, but that's essentially what that is. And then you can see here that the slope starts to go downward there. So now you can have qualifying short trades again. But for that, you need to have a little green candle close to the 20-period moving average. And it's kind of like it doesn't ever come. So unfortunately, on that one, I think you'd miss entry. But again, that's okay. You don't get every single one. I mean, at the end of the day, if you're profitable, be happy. Don't be like, God darn it, I missed 3 excellent moves and you're making money. Like, yeah, don't be like that. And it kept going and kept going. That was a very rare, I think that was the crash in the market today. That was a very rare moment. So normally, normal action would have pulled you back to the 20-period moving average a little more, and you would have found entry. So that was this was a rare moment. You would normally have made money on some kind of a downtrend right there, but that was rare today. Okay. Yeah, there's a couple other lines on here. Dave asks, I understand the yellow line is the 20-period simple moving average. What is the dotted line and the blue line? So the dotted line is the 8-period moving average, and that can help you like confirm your exit. It's like a trailing stop loss. So it's just another way to help you go, oh yeah, that was a good point to get out. Like remember when we had these two candles pulled back, and then on the next bar we exited right there. Look at that. It's like exactly at the 8-period moving average. That doesn't mean that when the 8-period moving average touches the bar, you should get out. It's just a little indicator to help you know that you are performing well. You're making the right actions. So I have that there for that reason. So when those two candles pulled back and I got out, and we got out like right there, look at it, it's almost exactly at the intersection of the 8-period moving average. So that just helps me know that I did the right thing, you know, and if price gets like really vertical on you, like that can happen, like it did at the beginning of the day. You'll see a lot of breathing room even on the 8-period, but you know you have to have a lot of momentum to get room on the 8-period moving average. And so like look, on that first move, it started to get some breathing room, and it would not have gotten like stopped out if you had used the 8-period moving average as your stop, which you shouldn't do. I just have it on there to give me that extra confirmation. It's kind of like a perfect trailing stop. You have to use the rules though, because you know the prices zigzag, and you can't use like any systemized like stop loss like that. You have to use a jaggedy stair stepping type of profit loss stop loss system in order for you to stay in the trade, because that's the way stocks move. They don't move in straight lines. They move in zigzag lines. So the only thing that moving averages are good for is for you to identify like trends. That's the best thing, like to identify trends and direction, that kind of a thing, and whether something's below a trend or above a trend. So that's the answer on that. And then I don't have this set up right on this particular screen. On another screen I do, but I believe this is the volume weighted average price, VWAP, this one right here. And I believe this one is the 200 period moving average. I'm going to double click this one. Yeah, that's VWAP. But I usually know that because I have that one dashed too. So let me try that. Yeah, there we go. And I usually have it a little fatter and transparent, somewhat transparent. Sorry to have to waste your time on this right now, but there you go. Okay, that's a little bit more like the way I usually have it. So I can clearly see now the two most important lines that I really want to look at are these solid ones, the 200 and the 20. Like that's a whole nother lesson about the 200, but that can be helpful too, to be using that line for certain things as well. All right, keep going, keep going, keep going. Then the market crashed. It rallied and then it crashed. And then we got this like uptrend, but we didn't get a little red candle with the green candle breakout, so we didn't take any trades there. And then the price went down, but the 20 period was flat. Just let someone in. And now it's going down, but our price action is not close enough to the 20 period average for us to really get a reliable entry, you see? That's really what it's about. We could take that move, we could guess, but it's not the same thing. We could guess, but the thing is, the reason why you kind of don't want to take this move when it's farther away from the 20 period moving average, especially you've been trading it all day, and to me, I don't know if you see it, but this is this is far from the 20 moving average compared to everything that's been going on in the day. You start to get a feeling for that stock. You know, how far does it peel away from the moving average typically? And on this day, this is kind of end of the move distance from the moving average. So it doesn't mean you'd be wrong to go in though. It just means it's a low probability that you're going to be right, and that means it's a higher risk, and so you don't want that. So, you know, if you don't get trades that are low probabilities and high risks, and you're frustrated because you didn't get them, there's something wrong with your thinking. You've got to get over that. You've got to be okay with, you know, I'm glad I didn't get that, because if I got that, you know, 9 times out of 10, I would have got screwed, you know, that kind of a thing, you know. So Let me get to the end of the day. Good. The end of the day is right there. The trend is down. We're looking for a little green candle close to there that breaks out with the red. It did not. Now the trend is going up. Basically, it's the end of the day. I'm not sure I would take any more trades now, even if I got a trigger. Because what's the point? How much of a move am I going to capture? So that'd be about it. That'd be about it on Apple that day. And I think overall, I think we didn't check every trade. Maybe we would have gotten one more semi-profitable trade, like maybe for 40 bucks. So overall, I think on that day with a $25,000 account, we probably made like, I don't know, what do you think, $220? That sounds about right. And that's just under 1%. And that's fine. Some days that's the way it is. Some days you make 3%. And that's really good because by the end of the month, $25,000 account making between 1 to 3% per day is $10,000. So if you're making $10,000, then I talked about in the money management class on Monday, you take out half. At the beginning of the month, you mark how much money you had. On October 1st, you mark how much money you had. And then at the end of the month, however much money you're up, you take out 50%, and that's your income, and you leave 50%. So $5,000 is what you would have made on a $25,000 account per month. You would have made $10,000, but you would have been able to withdraw $5,000.